Hello, Business 630 students. This is Professor Hassey. This is our week 4 Friday video for this fall 2 term, the week of November 15th to the 21st. And again, our topic this week is the cost of capital and the capital budgeting, and I'll be reviewing a problem to review all that. Also, I'll briefly go over our case number 1. The solution, or my interpretation of the solutions, has been posted to Blackboard. Again, that may look very different from what you presented, and that's okay. I will be posting case number 1 grades throughout this weekend. Also, tomorrow, on Sunday of this weekend, I will be introducing case number 2 Sunday morning. And in that introduction of case number 2, which is due the following week, November 28th, I will also be introducing the Electrics Incorporated case, which is our course case assessment, which is a separate case, which is due the last week of class. So those 2 cases, one which is due this week, coming week, and the other is due at the end of the term, will be introduced via video on Sunday morning. So let's talk about capital budgeting. And I'm sure a lot of you have done this before, but some of you, it's been a while. So I want to go over the process. This is what you'll be doing in case number 2, this capital budgeting analysis. It's a spreadsheet case, no writing whatsoever. So let's take a look at it. Remember, one of the key things for a financial manager at any corporation or not-for-profit corporation, any type of business that's creating services and products for customers, is to invest in assets that will produce these products and services. How do you make the decision of whether an asset investment is viable or not? Well, one of the key determinants is a financial review, a quantitative review of an analysis, which is called capital budgeting, where you determine how much your capital is going to cost, then put that cost of capital as your discount rate to determine the cash flows being created off that investment to determine its return. And that's what we're doing here, which is part of the beginning of the next 2 weeks of our study. This week, we're talking about the number crunching. Next week, we'll be talking about the strategy and the risk involved in that strategy. So let's take a look at determining the cost of capital, which we've already begun our work earlier in earlier videos this week. Remember, the cost of capital is what it cost us at the given moment in time. And that's related to 2 things. The capital structure of our company, what currently is our current capital structure? How is the company currently funding their assets? And the second thing is the status of our company in the market as far as return and interest. And that all plays into this analysis of the cost of capital. If you take a look at this example, again, this is posted in week 4. This is a capital budget analysis. I'll be posting the solutions when I'm done with this Friday video. You'll have 2 files there. One is a blank file, just like this one, that you can complete on your own. And a second is the answers that we're doing in this video. So let's say this company has a 60% debt to assets. In other words, 60% of the long-term investment in this company is in debt. So that means our percentage is 60%. Well, if our debt is 60% of assets, in order for everything to balance out, that means equity must be 40% of assets. It has to total 100%, 60-40. Now, what is our cost of debt? Well, this company currently has a tax rate of 30%. And why is that important? Because you can deduct interest on your corporate tax return. They're currently averaging and paying 9% on their debt. So their after-tax cost of debt would equal their interest rate on their debt, which is 9%, and you're going to multiply that times 1 minus the company's tax rate, which is 0.3 or 30%. In other words, you're going to deduct the interest expense, the taxable interest out of that 9%, and you're going to get 6% as your after-tax cost of debt. In other words, 9% times 70%. So it's really costing us 6% our debt. What does that mean? We're still writing checks to the bondholders or the people we lend money to, or lend money to us as 6%, but we can deduct 3% of that debt on our taxes. So that's the cost of debt. And then our cost of equity. What is the, oh, let's put this down here. So our cost of debt is 6%. All right. And then we'll weight that debt by taking the capital structure percentage of debt and multiplying it times our after-tax cost of debt, and we get 4%. But let's make sure we round these to the nearest 100th decimal. And there we go. We get an after-tax cost of debt of weighted of 3.6%. Always go to the 100th decimal point. Don't give me rounded percents. You can round dollars, the whole class, but don't give me rounded percentages. And I wanted to show you that right there. So our cost of debt is, after-tax cost of debt is 6.3%. We multiply that times 60%, and we get 3.78% as our weighted after-tax cost of debt. Our cost of equity is the capital asset pricing model, taking the risk-free rate of, in this case, 1.75, and multiplying it times the market premium, which is the market rate minus the risk-free rate. And that market premium is multiplied by the beta, or the risk of the company, 1.25 in this case. Add that to the risk-free rate, and we get our capital asset pricing model, or cost of equity. It's what the investors expect as a return on their investment based on the current risk in the market of this particular company and the risk in the market of no risk and average risk. No risk is the risk-free rate with a beta of 0. Market risk is the market premium, market rate of return minus the risk-free rate. So let's put that into a formula. So we're going to take 0.75, and we're going to add that to the market premium of the market rate of return of 0.09 minus the risk-free rate 0.0175, and that's going to be multiplied times our beta of 1.25. Okay, but let's make sure we have the parentheses right. So we're going to double parentheses this formula, making sure we include all that calculation in that number, and that'll be added to 1.75%. We hit enter, we round to the nearest whole 100th decimal, and we get our capital asset pricing model of 10.81%. That's the risk-free rate plus the market premium, which is the market rate of return minus the risk-free rate, times the beta of the company. So let's put 10.81% down here. We weight that, oops, let's make sure we, there we go. And we weight that by taking the capital structured percentage of equity and multiplying that times the cost of equity. We round that to the nearest whole number, 100th. We take that and we get our 8.1% weighted average cost of capital, okay? Pretty easy. The key thing is just understanding understanding the linguistics. What do these numbers mean? After taxes, we pay 6.3% of our interest on our debt. We have a capital structure currently of, this changes every day almost in most companies, but we have a capital structure of 60%, 60% of 6.3, 3.78%. We have a capital structure of equity of 40%. It's got to be 40 if our debt is 60. Our expected rate of return with the capital asset pricing model based on the risk in the market is 10.81, weighted 4.32. Add those two together, 8.1%. That's our cost of money. In other words, any asset that we invest in today should have at least a return on the investment of at least, and probably a lot more, of 8.1%. So then we go to our base analysis. And again, this is given to you in the problem, and now we're going to complete this. The good thing about this is it can be your template for future problems. Case number 2 and the electrics case. Those cases will be different time periods and different numbers, but you can use this as a template to do that. First of all, let's do this. We just determined that our weighted average cost of capital is 8.1%. So that goes there into one of our variables. And here's all the rest of the variables in this case. We're going to be investing $1 million over 10 years. That's the depreciable life of the asset. Remember, the depreciable life is how long we can depreciate an asset according to IRS regulations and our public accountants. And since that's how long it can be depreciated, that's how long the financial analysis of this investment is. And all these other variables, which we'll now go over. So now let's set up our spreadsheet. Year 0 is today. Let's put that up here. This is today, right? This is what's happening today in our business. Let's put that in nice color. There we go. That's today. So we're investing $1 million. All right. Then we project what our sales and expenses and cash flow is. The bottom line is to determine the net project cash flow over the depreciable life of the asset, because with that cash flow, we're going to bring those dollars back to today and do our 4 return analysis to determine if this is a worthy investment. All right, and I have this spreadsheet set up where formulas are throughout the spreadsheet, and everything is done pretty neat. So that's why I'll show you this. So we're selling 25,000 units a year of this product that's being produced by this $1 million investment in equipment. We're selling 25,000 units a year at a sales price of $20 a unit. So in this year 1, we'll put in the formula equals units times the selling price of $20. And there's our first year's sales of $500,000. Now look what this spreadsheet automatically did in the way I had it set up. If you notice, the next variable here is the annual change in sales price of year 1 is 2.5%. So now I'm inflating my revenue 2.5% every year to show how inflation will play into my increasing my selling price of my product into the future. Why? Well, if anybody's been paying attention to the news today, right now our current inflation rate is about 6%. But this company feels in today's market that they can get away selling 25,000 units every year with a 2.5% increase in their selling price every year. The next thing we do is our expenses, split into 3 areas. Variable cost, which is a cost per unit, fixed cost, which is a flat rate of cost, and depreciation cost. Our variable cost rate is $8 a unit, and we have an inflation rate for variable costs of 2%. So we go into the year 1 equals 25,000 units being produced and sold times the $8 variable cost rate. And there we get $200,000 as our variable expenses, and it increases at 2% a year. Pretty nifty. Notice my formulas are also now beginning to determine the earnings before taxes and the tax rate, as these preset formulas are here. So our variable costs are $50,000. It's a flat rate, there that is. And notice the inflation rate for fixed cost is 1%. Now, some companies use the same inflation rate for every variable. Some use different ones, like in this case. That's what you have to look for when you start putting your analysis together. What are these variables and how do you apply them to the template of the capital budget analysis? Our depreciation is given at $100,000 a year. So that means we're going to fully depreciate the asset over 10 years of 100,000. So let's put 100,000 there. And now that fills out and populates to the 100,000 every year for 10 years. So now we've just calculated our earnings before taxes. This formula here has taken the revenues, sales, and subtracted out variable cost, fixed cost, and depreciation. Earnings before taxes. So now we take 30% of that earnings which is here, 45,000, and we get our net accounting income to be generated off this investment. Net accounting income. And notice it increases by the taxes and the variable costs and the inflations and all that going out. So we're projecting a $1.32 million profit, net income profit off this investment of $1 million. But that's not the full story of a capital budget analysis. You now have to take into account other things like salvage value, depreciation, and working capital as additional cash flows that add to this problem. And as you can see, they're all filled out here except for the salvage value. And I wanted to walk you through that. The salvage value, again, an estimate by this company, probably the purchasing agent or whoever purchased this equipment, says that at the end of it, fully depreciating this asset, we're going to have a value of $50,000 that we can receive as salvage or scrap on this equipment. Now, since we have fully depreciated the asset over time, it will have a book value on our accounting books of 0. So if we get $50,000 of salvage or scrap at the end of its life, that's going to be considered a gain on the disposal of that asset. Remember back to our accounting days. And that gain has to be taxed at our tax rate. So in year 10, we'll put in $50,000 as our salvage value, but we're also going to multiply that times 1 minus T. Remember, 1 minus T is 1 minus our tax rate of 30%, which happens to be 0.7. And that will be our net after tax gain on the disposal of the equipment at the end of the life of this asset. Now, we might own this asset for 20 years, but its accounting life, its financial life for analysis is its depreciable life. Thus, we have the salvage value in year 10. Again, remember, this is a budget. It's not the real numbers, but hopefully if we do this correctly, it gives us a good interpretation of this project. So 35,000 in year 10 after tax. We add back depreciation to cash flow. Why? Depreciation is a non-cash expense. So we're really making $250,000. We're really making $258,000 earnings before taxes. But depreciation reduces our tax liability as an operating expense of the asset. But since it's a non-cash, we add it back after we've paid the taxes as additional cash flow to this project. And the final capital budgeting variable that we have to be concerned about is this one right here. Working capital as a percent of next year's sales. In this case, it's 12%. This 12% is determined by the cost accountants, the internal auditors, the public accountants of a company, of what additional capital do we need to invest in this $1 million piece of equipment to keep it going. Okay, it's just like buying a car. You purchase a car for $30,000. Is that the end of your expenses and the end of your investment into that car? No, you have to maintain it. You have to get insurance. You have to get registration every year. You have to do upkeep. That's additional cash you have to dish out to maintain that asset. Of hopefully, and if this asset is generating revenue and profit like it is here, you'll get that money back over the course of the investment. But we have to account for that cash being dispersed throughout its life. And that's what the working capital is. Remember, the definition of working capital is current assets minus current liabilities. It's a balance sheet item. So this is a cumulative figure over the life of the asset. Now, let me explain. The working capital rate in this problem is 12%. It's based on the next year's sales. So in year 0 today, we need to take 12% of the first year's sales, $500,000, and that's going to be an additional cash outlay of $60,000, 12% of 500,000. But then as the sales of the next year increase with inflation over the life of the investment, we have to adjust our working capital by that increase every year. In other words, in this calculation in year one, what is the next year's sales? Well, it's $512,500. So that means sales have gone up $12,500. That delta from year two to year one, you take 12% of that, and that's $1,500. Remember, this is a balance sheet area, so we're accumulating it. So at the end of year one, we've accumulated $61,500 of cash going out as working capital to maintain this asset. What's 12% of $512,500? $61,500. And this changes as revenue increases. But look what happens in the final year. We've accumulated from year 0 to year 9, $74,932 of accumulated cash outlay. But now the final year of the project, of the asset, of the analysis, we add all of that back in. 74,932 as positive cash flow. You can get that number by just taking 12% of the final year revenue. And you know, if you take this all across and foot it, it equals 0. Now we've completed all the variables, both revenues, expenses, taxes, cash flows, and we come up with $2.4 million of accumulated cash generated by this investment, net income plus after tax, after net income, cash flow, salvage, depreciation, working capital, $2.4 million. And now we're going to use that in our analysis of return. So what is our discounted cash flow? Well, our discounted cash flow is taking this 10 years of future cash and discounting it back at our cost of capital, which we calculated here, 8.1%. So let's do it. Formulas, function, financial, net present value, NPV. There it is right there, NPV function. Our interest rate is our cost of capital, which we calculated as 8.10%. Our values are years 1 through 10 cash flow. So we just drag our mouse over the 10 years of cash flow, years 1 through 10, F21 to O21, hit OK, and it calculates. Whoops, hang on here. What did I just do? I did something wrong here. Oh, wait a minute. Let's back up here. Did something wrong. What am I wrong? Let's try that again. Function. Mr. Hasse, it's too early. NPV. There we go. Our rate. Oh, here it is. 0.0810. There's our interest rate in a decimal. The values are year 1 through year 10. There we go. And here we go. Now we hit it. I put the decimal, I put the percentage in wrong, and we hit OK. And there we go. 1,564,799. So that's the $2.4 million of total cash flow discounted back to today at our cost of capital that we determined as 8.1%. And notice what the formula does. Our net present value is the difference between what we're spending today, including working capital, $1,060,000, compared to the discounted cash flow. So we're getting a net present value in today's dollars off this investment of $504,799. That's looks pretty good. What is our internal rate of return? Well, our internal rate of return is 17.03%. That's this money in percentage. How did I get that? Well, I'll show you. If we go to formulas, function, financial, IRR, all we have to do is just paint from year 0 cash flow to year 10 cash flow, and the computer does the work for us, 17.03%. So that's that 504,799 in a percent, which is a good thing. It's costing us 8.1% to make 17.03%. Profitability index is the relationship of discounted cash flow to the net cash flow of the project in a ratio. So we just divide 1,564 divided by 1,060,000, and we get a ratio of 1.48 times. Anything over 1 is a good thing. And then what is our payback in years? Our payback in years is how long does it take us to recoup the $1,060,000. There's no discounting here. So again, at the end of year 1, we've invested $1,060,000. We've earned $203,500 of that $1,060,000 back at the end of year 1. That means we still have $856,500 to pay back. All right. So in year 2, we take that amount still to be paid back and we add in our year 2 cash flow of $209,063. We still have $647 to pay back. And now that we got that formula there, let's just slide it across a couple of years. And as you can see, at the end of year 4, we still have $211,987 to pay back of our investment. And notice in year 5, we have $226,000 of cash flow. So that means we're going to pay this off in year 5. How much of year 5 will be paid off? Well, all we need to do is just take the amount that still needs to be paid back, $211,987, and divide it by the year 5 cash flow. And we get, let's make that a percent, 94%. So it's going to be, in other words, we still have 94% of year 5 to get to the payback number. So our payback in years is 1, 2, 3, 4.94 years. That's our payback, 4.94 years. In other words, 4 complete years plus 94% of the 5th year, 4.94. So we're paying it back in a little less than half the time. So in other words, now that we've completed this project, and let's save this. Always save your files. Let's save this as week 4 solutions. So I'll put this file into Blackboard when we're all done, solutions. And there's our solutions for the capital budget. And it looks like, and it is, that this investment of $1 million with these variables in this economic environment at our cost of capital, we're going to have a positive return in dollars, percent, a ratio, and pay it back in less than half the time. Pretty good project. Looks positive. We'll talk about the strategy behind these numbers next week. But that's the process by which we are going. So what I urge you all to do this weekend, if you can, is to take the blank copy of this file, go through this and see if you match the solution numbers of this file in this file that I present to you. Because case number 2 is doing exactly this, plus the risk analysis. This is chapter 11 of our text, or better yet, this is called scenario and sensitivity analysis. I'm going to do the scenario analysis today, and I'm going to do the sensitivity analysis in my Sunday video this weekend when I introduce case number 2. But you have to do these 2 things to the case. In other words, we're going to take what is called the base analysis, which this is, and then look at different changes to this analysis by output of units and by changing of the key variables, selling price, variable cost, and the weighted average cost of capital. Change those by these different deviation amounts and see how our project change in profit and value with these additional scenarios and sensitivity variables. It's called risk assessment. Let's take a look at what our scenario analysis would be. Now, scenario analysis is basically saying, what if we have to sell more or less of our units? due to economic conditions. And it determines that and it weights them by the economic probability of those events occurring. Now, all these numbers have to be given to you. All right. You can't calculate them. Somebody in your public accounting firm or your cost accounting firm is determining these deviations and these averages and these probabilities. You are given to them. So, first of all, this is our base case. And let's make that instead of average. That's our base case. And that's the case we just did 25,000 units. And we had an NPV of 504,799. So let's just put that there 504,799. All right. And what this does is now there's a 50% probability of this occurring per our cost accountants, our statistical people of our business. There's a 50% chance of that happening. So that's weighted to a 252.4 probability net present value. Then we go back to our base analysis and let's just change one number. And we'll highlight that here. Let's just change one number. Remember, we're 25,000 units, but now the scenario says, well, what happens if we have a very strong economy and we can sell 35,000 units? Boy, wouldn't that be nice? Well, let's go back and change this to 35,000. And because we have our spreadsheet already organized, by just putting that number in that cell, look what happens. Sales change, variable costs change, net working capital changes, and look what happens. We end up making $1.117 million of net present value under this best scenario. See, if you have a template that works with good formulas, just one change of number can give you additional information. So under this scenario of 35,000, we're making 1,117,358. So let's put that here. 1,117,358. There's a 25% chance of that happening. So we weight it, and there's that scenario. Let's go back to the base case and put back in our 25,000. Everything goes back to where it was originally. And now let's take a look at the worst case or weak scenario. Geez, if we have a terrible economy, if we want to sell our units at $20 a unit with that inflation rate of 2.5%, we can sell 12,500 units a year. This might be during a pandemic. 12,005. So we go back to our base analysis, put in 12,500 units here. This is going to be not looking very pretty. And there, whoops, correct. We're now going to have a negative 260,899 net present value, a loser. Notice how the internal rate of return drops below our cost of capital. Notice the profitability index drops below 1. Our payback in years, we'd have to recalculate that, but that's going to take quite a while to happen. So again, big changes. So under the worst case scenario, 260,899 negative. So we'll put that here, negative 260,899. And that's weighted by 25% likelihood. Let's make sure we go back to our base case and go back to our original number to make sure everything is back to normal. There it is. That's what makes spreadsheets so neat. You can just set this up where it does all this information for you with one keystroke. And go back to our risk analysis. And we have just completed the scenario analysis, looking at the profitability, taking into account a change in output of sales and the likelihood that that would occur. And we weight that and average that, and it comes up to being $466,514. Now, what does that tell us? It tells us two things: that if we do end up having sales drop to 12,005, we're going to lose money. But you weight that by the probability of likelihood of all these scenarios happening. This case is still producing the probability of still a pretty good return of $466,514 of net present value. So that means the risk is there and it can happen, and we can see what that risk will be, weak output. But taking that all into account over the overall probability of that happening, we're still probably going to make some good money in this project. But also this gives us an idea of if the economic conditions do change during the 10-year life of this project, that if we start dipping below 25,000 units that we're going to sell, remember, we're selling these at 20 bucks plus inflation. So if the market says, oh, you can only sell 15,000 units over the course of its life, we get an idea of how our profitability will change as unit output adjusts. Gives us a good idea to adjust factors during the course of the life of the project. The scenario analysis. In a later video, in another couple of days, I will go over the sensitivity. The sensitivity analysis is to go back to the base analysis and change key variables one at a time. Change the selling price. And how does that affect profitability at different levels? Change the variable cost rate and how that affects the NPV at different levels, and changing the WACC. How does that affect profitability? And we put that into this table to show the range of how different changes in prices affect net present value. And then we'll chart that change over here. And we'll do that on Sunday morning when I introduce case number 2. That's the sensitivity analysis. That's a showing how, in this case, scenario is output, sensitivity is key variables of the case, and we'll show that. And if you want to go ahead and use this file and try this over the weekend, be my guest and see what you come up with. As you fill in this chart with these NPV numbers, this graph will populate. So try that. So that's our Friday video. A look at WACC, a look at the base analysis to get us set up for case number 2. There's now 2 files going to be in your week number 4 Blackboard, a blank file, which you can work on yourself, or the solution file, which you can see the results of the work. And then we'll go back to this file in our Sunday additional video. Mr. Hassey's working a lot this weekend. All right, everybody, have a great weekend. Hope this helps. Capital budgeting, there's nothing more important to a financial manager than this. Have a great weekend. We'll see you again in a couple of days. Adios.